Good afternoon and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, December the 14th, and want to take just a brief minute to discuss what markets did last week as the S&P 500 finished another positive week, up 21 basis points or 0.21% on the week. The mid-cap index is measured by the S&P 400 right there with the S&P 500, up 25 basis points on the dot, or up 0.25%. But the real winner last week was the S&P 600, or the measurement of small caps that we use, and that was up 1.3% on the week. So what we're starting to see over the last 6 weeks is a pattern take place of the winners selling off and the losers being bought. But we'll get into that in more detail in just a minute. But wanted to talk about what has really been driving the markets in the last week and this week, and why we saw such a giant move up yesterday. So this week, heading into this week, we were going to get CPI on Tuesday, as well as a Fed bank meeting and Chairman Jay Powell's comments yesterday at 2:30. We got the announcement from the Fed yesterday at 2 o'clock what their decision on rate hikes were going to be. So let's talk about CPI for just a second. It continues to come down with the measure year over year of headline CPI at 3.1%, continuing to fall from where it was just a year and a half ago in June of 22 at over 9%. We are now down to 3.1% on headline CPI. So the markets were taking that and digesting that, and we were kind of marking time. But we really were interested to see what Jay Powell had to say at his press conference yesterday, and what if we were actually done with the rate hiking or not. And the market had priced in that the Fed's done hiking. And in fact, what we got from Jay Powell yesterday was in fact that the Fed is done with their tightening cycle. And he, for the first time, discussed cutting rates next year as a tool that he sees necessary as inflation continues to fall. And that's what really caused the market to take off yesterday after those comments there, when he talked about more cutting and not tightening that would be needed for the economy, giving more faith to engineering the soft landing that is taking place in the U.S. economy. The economy is still strong, and what's different, and one of the things that we wanted to talk about this week, is why did so many economists and Wall Street pundits get the looming recession so wrong? If you recall, going back to the fall of 2021, that's when the calls for recession started, and we would argue maybe we hit a brief recession in 22. But the deep recession that everyone has been counting on hasn't happened. Now, there were signs that lead to recessions with the inverted yield curve and things along those lines, but you also have to remember that we shut down the economy during a pandemic and then stimulated the economy. But when we reopen the economy for the United States, it's not like you go in your car, you turn the keys on, and it just starts and everything is equal, and you just put it in reverse and everything's back to normal. It started in bits and pieces, and it took the supply chain a little while to catch up with the demand, because people had money, were given money by the government, and went out and spent that money. Business takes time to get back up. Supply chain takes time to get back up and get running to catch up with the demand. And that's what we're finally starting to see, is that supply is finally caught up, demand is coming down, and supply is caught up with demand. And that's why inflation is coming down, or not growing at such an exorbitant rate year over year. So what we see is what is happening over the last 6 weeks, and what I'm really excited about, and what's happening today. So what we've talked about all years, this Magnificent Seven, has really driven the index higher based on their market cap weights, and the rest of the market really hasn't participated. Well, I'm here to say that it's kind of starting to change. I'm not ready to call for a full-on bore, it's flipped and that's what's going to happen, but expect a little bit of this to happen, maybe for the remainder of the year and even into next year. But the index itself right now is the S&P 500's up 20 basis points, which is great. But most of the Magnificent Seven are actually negative today. However, if you look at the equal weight S&P 500 as we're talking right now, the S&P is up 20 basis points, or 0.2%, while the equal weight is actually up 1.3%, over 1.3% right now, over a percent over the S&P 500. And so what you're going to see happen is one of the things that we discussed about in the last couple of weeks, is you're going to see the selling of your winners of this year your Magnificent Seven, to buy the other 497. So because of the weighting that they have on the index, expect the index to tread water, not do much, maybe down slightly, up slightly, but underneath the index, inside the index, there's a lot of encouraging action happening, and there's a lot of really, really cheap stocks. Mid-cap stocks are so cheap. A lot of cheap value stocks. You're going to find great bargains. So if you hear the headlines on CNBC, the market's overbought, the market's overbought, the market's overbought, maybe some stocks are overbought, yes, but if you take some time and really do a level or two down into the market, you can find some great bargains. So if you want to know how you can take advantage of this or how to position yourself moving into 24, or you need a plan going into 24, give us a call. We'd love to talk to you and help you through that. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. Have a wonderful rest of your week, everyone. Thank you so much.